good afternoon and welcome from the Price Group. I am Matt Price. Randy Price had a confluence of issues. His wife, my mom, broke her arm. My sister, his only daughter, just got engaged this past week. And on top of all that, they're doing a house project, and he was called away here at the last minute. So stuck with me, but have a lot of what we think is some really interesting information to cover here regarding the markets. We kind of will do these webinars on an ad hoc basis based on when we're getting a dozen or 24 questions from different clients on the same topic. We think that's when it's really something to consider, where we do this for all clients. So glad y'all are here, and think we will spend the next 30, maybe 40 minutes time well spent. So let's jump in. Who are we? For those of you that are not as familiar with the Price Group, Randy Price, he'll try to say he's my older brother. He's actually my father. 45 plus years of experience between the both of us. We follow a fiduciary standard, which we think is really important. And as many of you know, we have a retirement niche with over 90% of our clients in retirement or just on the cusp of retirement. So we've been really humbled to receive some rewards from Barron's, Forbes, Financial Times. We're both certified financial planners. You get our weekly emails. You've probably seen one of our recent Wealth Coach podcasts. We're going to be adding a number of new episodes here in the next few months to that. So stay tuned there. But here's what we'll be talking about for the next 30 or 40 minutes or so. Is the economy healthy? The geopolitical tensions, rising interest rates, that's top of mind for really any and all fixed income investor. And then some statistics and some history to hopefully encourage us to think with a long-term perspective opposed to a short-term perspective. So here we go, a healthy economy. We always like, my wife will say, you want the good news or bad news? And I always like the good news first. Let's look at the good news on if the economy is healthy or not. This may or may not be familiar to you, but this is our recession dashboard. We send this out on a quarterly basis by email, so we'll be sending this out, publishing it here probably in the next few weeks or so. This is as the end of February, the latest data we have. But what we're doing here is we're looking at these 12 indicators on a regular and consistent basis to help us determine how healthy the economy is. And as you can see here, we have 10 green expansion arrows. We have one moderate and we have one negative, the wage growth, which is given the fact that wage growth has been accelerating for the past 12 months or so. But overall, we're still very comfortable with the health of the economy as it pertains to the 12 fundamental indicators that we're looking at here. If you're wondering, well, how have these 12 indicators held up historically? Let's take a look back at 2008, and moving from left to right, you can see here the middle of 2006, going through the middle of 2008, and how these indicators slowly started to deteriorate well before you had the financial crash, which came really the summer, early fall of 2008. So not a perfect system. Anyone who says their system's perfect is lying to you, but it has worked well in the past to help us pick up on when a recession could be imminent around the corner. So as of right now, we think the economy looks healthy. We'll continue to monitor this, continue to send this out on a regular, reoccurring basis to clients. Here's another chart, U.S. earnings growth, and we say it continues for now, ... But the EPS, earnings per share, are one of the metrics we use to look at how profitable the economy is, using the 500 largest stocks, the S&P 500, on a regular and recurring basis. We have a blog post that will be sent out this afternoon, maybe tomorrow, and we're talking about the divergence that we're seeing. So this chart here, you'll see you had that dip. Everyone remembers spring of 2020 with COVID. We turned the world's economy off temporarily, and then just a few short months later, we said, let's turn it back on, and that obviously is not as easy as turning the car on or off in your garage. But since then, we've seen an acceleration of earnings growth, and typically before a recession, you start to see these earnings numbers or these earnings forecasts rolling over prior to a recession. What does that mean? A lot of the companies will come out on their quarterly calls and say, you know what, we are, instead of estimating that we'll make $100 next quarter, we're revising that down to $90 or $95. And so you'll see this lowering of earnings expectations in the future. And what really is interesting is we haven't seen that yet. Now, there are obviously exceptions to that rule. Every company is different. But if we're looking at the market as a whole, we haven't seen a majority of companies reducing their expectations for the rest of 2022 or into 2023. And actually, on the contrary, we've seen over 40% of the S&P 500 companies increase their earnings estimates moving forward. So we have this pull and this tug back and forth of one party is saying a recession is imminent, it's right around the corner. We have another party saying stocks are undervalued or fairly valued, and it's a real dichotomy here when trying to figure out who to listen to and how closely should we listen to them. But as of now, earnings estimates look good, which is a good thing for stock investors. The consumer is also in a really healthy position. A busy chart here, but what I want to draw your attention to is this box in the top right-hand corner, the household debt service ratio. All this means is how much debt does the average family have compared to their overall nest egg, their assets. And as you can see, we're at one of the lowest levels dating back to 1980, which is a good thing. We peaked here at the end of 2007. We all know what happened in the following 12 months. We're reminded of one of the famous stories that many of you might have already heard or it's been over a decade since then, but there was a strawberry farmer out in California making $30,000 a year, and two different banks approved his loan to buy a $1 million house back at the end of 2007. Happy to report we're really not seeing that from the banking side either right now. Banks are being a little more stingy than they have been over the past few years, and a lot more stingy than they were back in 2006, 2007. So we think the consumer is in a great spot. You can see in the bottom right-hand corner here, net worth is up for the average family just based off the fact that markets have had a good 10-year plus run. And then not to mention balance sheets for companies are also healthy. What we're looking at is a number, the amount of cash that the S&P 500 companies hold on their balance sheets. You can see it as at an all-time high, which is a good thing. This is a good thing just because cash is king when things go awry, and companies are able to withstand a lot of economic turmoil with the more cash on hand. So we think moving forward, the real play for any and all investor is looking for companies that have strong balance sheets, have what we call a lot of free cash flow, and we're biased, but we love dividend-paying stocks that not only pay dividends, but hopefully increase those dividends year over year is the sign of a really healthy company over the long term. So, have some good news. The bad news, government spending is not healthy. Shouldn't really surprise anyone on the call here, but the interesting piece of this is looking at the federal budget surplus or deficit. Once again, in the top right-hand corner, you're seeing these deficits moving forward over the next 7-8 years being lower than what they have been, but that doesn't really take into account the total. Here, down in the bottom right-hand corner, we're looking at the total net debt. Regardless of where you sit politically, it doesn't seem that politicians, red or blue, are really worried about this at the present. The market is not really worried about it at the present either. But we would say this is our long term. We think the biggest headwind. There's a lot of studies out there. Once the debt levels exceeds a threshold of the GDP, the gross domestic product, it does slow growth into the future. And that number is right around 100%. As you can see here in this bottom right hand, we're right at that 100% level. So don't think it is something that really affects markets today, tomorrow, next week. But once again, long term, think 5, 10 plus years, we think this is an issue that is going to have to be addressed at some point. Some more leading news, and this is a question we've gotten a lot over the past few weeks. Oil prices, are they a leading indicator for a recession? And as you can see here, the grayish backdrop is when a recession occurs. And when you do get a spike in these commodity prices, most specifically oil, it is leading up to a recession. I would say this is like asking the question, is a hurricane coming after it's been raining? Typically, all hurricanes happen after you've had some rain, but just because you have rain, it doesn't mean that a hurricane is right around the corner. So a lot of different factors at play here. It's worth noting that where crude oil sits today, about the same price that it sat in 2008, end of 2007, at its peak. And the way that we're looking at that is there has obviously been some inflation over the past 15 or so years. So having the same price would mean that we're at, on a relative basis, a lower, quote-unquote, oil price than we were back then. Nonetheless, we don't like crude being this high for a host of reasons. But this is a good, compelling argument, or counter-argument, I would say, of looking at history. We don't think it tells the complete story, though. So inflation is here to stay. Not many people are arguing that otherwise, but at what level? And that really is the $64,000 question that we are trying to answer. When you look at the breakdown of the consumer price index, which is really the main inflation barometer that people are talking about on TV or you're reading about online, two of the biggest pieces of that pie are new cars and used cars. So you've seen the price of new cars just skyrocket over the past 18 months, and same with the used car market. So at some point, we think that piece settles down, which would tame the overall number. But we don't think that inflation, the word that's been thrown around a lot, transient, we don't think that is necessarily true. We do think some of the inflation does dissipate toward the second half of this year, but we think inflation is going to be around for a while. You heard just yesterday, Mr. Powell, the Federal Reserve Chair, came out and said that they would be open to fighting inflation at a quicker pace than they otherwise had mentioned earlier. So just last week, you got your first interest rate increase of 0.25%. There's expectation of at least another 0.25% next month. Some people are calling for 0.5% increase next month. So to be determined on what does happen. The old saying, we want to buy the rumor, sell the news. How much of this information is already baked into interest rates and bond prices? And if you can answer that question, let us know, because we would love to hire you. But all kidding aside, that is what we're currently wrestling with. How much of this information is expected already in the markets? So the Federal Reserve, we look back at history, the early mid-90s, the Federal Reserve did a great job of being, quote, just right. But the Federal Reserve is too slow to raise interest rates, inflation can get out of control, be higher than we want. If the Federal Reserve raises interest rates too quickly, you stunt economic growth, which typically has historically led to a recession. So it's a real delicate balance here, and we would say this is one of the obvious risks that we have moving forward in 2022 and then also for next year as well. But let's take a few minutes to talk about geopolitical tensions. It's obviously all over the news. We think it is something that is to be paid attention to, but not something at this point to necessarily have us change course with what we're doing from an investment perspective. So our thought is, and we could be wrong, this wasn't what Putin expected coming out of the gates. We wrote a blog just kind of right at the beginning of all this mess, and we thought it would be a swift movement to the capital of Ukraine. We were wrong, and I think Putin was kind of, in some respect, wrong with that as well. The Ukraine people have really been encouraging to see the whole world kind of come together behind Ukraine in that perspective. But the sanctions, there was a 60-minute segment just this past Sunday on the sanctions and if they're working and how well they are working. And what they're doing is they're essentially cutting off the Russian economy from the rest of the world. And that's putting the private sector, the Russian people, more specifically the upper class, the wealthy Russians, in a real peculiar position and almost leveraging them against Mr. Putin. But I read a really interesting statistic. Once all of this is over, whether it's 2 months, 6 months, the Russian economy is expected to be half as big as it was before this started. So a huge price to pay, and that is really taking out the most important piece, the price of human life, but just looking at it from an economic perspective, a huge price to pay for this mess over that's happening halfway across the world. But overall, we don't think right now this spreads into any NATO country. We don't think this becomes a World War III. That's our base case we're operating under right now. Obviously, things can change, but as it sits today, we do not think this crisis warrants a real change in how we're looking at earnings, how we're looking at investment portfolios moving forward. Thought this was interesting. We put together the quote-unquote playbook that Putin used back in 2008, 2014, and then this year in Ukraine as well. And it looks like, for the most part, the same sequence of events has happened in the past that's happening this year, with the next being a ceasefire. So does that happen? We'll see. I read another article that kind of compared Putin to a pit bull. Put a pit bull in a corner and you just don't know what's going to happen, how the dog will respond. So a lot of uncertainty around this, something we're obviously paying close attention to. But if the present is anything like the past, hopefully a lot of the worst piece of this is already in the rearview mirror. We've also gotten a number of questions on how is this going to affect earnings for American companies. I think that's a great question. Here's a look at the S&P 500, the 500 largest stocks in America, and what percentage of their revenues come from Russia. As you can see, the most recent data we have, it's less than 1%, which is, I don't want to say an immaterial amount, but it is not a material amount when you look at the overall revenue numbers. There are certain sectors, certain companies that are more heavily invested in Russia. You've seen a lot of these companies publicly come out and say that they are closing business there for the meantime. Coca-Cola said they're not shipping any more product. McDonald's has said they're closing all their franchise stores, and so it's they are kind of closing the wall to the Russian economy for the most part. I earlier probably mistakenly used the word interesting of this information we're going to look at. My wife often reminds me, she says, they don't confuse your interest with the interest of the general public. So I find this very interesting. Maybe interesting is not the right word to use. Maybe a better word would be helpful. But the question we have gotten as well, how much does this matter from an economic perspective? So what we did, we took Apple, company that everyone's familiar with, and that company's overall net worth, and we compared it to the Russian economy as a whole and then the Ukraine economy as a whole. Apple is 10 times larger than the Russian economy and 2,600 times larger than Ukraine's economy, which really is kind of an eyeball-popping statistic. Needless to say, we think this is important from just a overall national security for the country, the world, and once again, our hearts break for the Ukraine people. But Ukraine, from an economic standpoint, is not a powerhouse, and Russia, the biggest piece of their economy has been oil and gas, which it'll be interesting to see what some of these European countries do on if they turn off the gas spigot or we stop buying as much crude oil from Russia moving forward. So here's a look at the long-term impact from geopolitical events dating back to World War II, at the beginning with Pearl Harbor. And as you can see, the U.S. economy as a whole it keeps on keeping on, is what my grandma used to say. So the U.S. economy has overcome a number of disputes, wars, whatever label you want to throw on them in the past, and we don't think this one is any different moving forward. So some encouraging data when we look at it from a long-term perspective. A few key questions specifically as it pertains to this geopolitical tension. Does Putin settle down or does he double down? Back to the pit bull example, we're not sure. We've gotten questions on a nuclear threat, a cyber attack. The nuclear threat would obviously be the most scary option. Cyber attacks, my understanding, and we had a former FBI agent on a webinar just a few weeks ago that discussed this. There's hundreds, if not thousands, of cyber attacks specifically from Russia on a daily basis in this country. So a cyber attack would not necessarily be anything new, just given the fact that this is happening on such a regular and reoccurring basis currently. So, fourth question, if a ceasefire is signed, what will the sanctions be in reverse? Something that I also read this past week, the sanctions that are put in place are expected to be there for anywhere from 5 to 15 years. If that's the case, the Russian economy doesn't get back to where it was before this for another 20 to 30 years, which is just horrible for all parties involved. Russian civilians who are against this, Ukraine, etc. So, and then I'd say the other wild card, which there has been some writing about, probably not as much, is the China situation, and they follow suit with Taiwan. But wait and see. Something that we are paying attention to. Like we said earlier, don't think it throws the train off the tracks as of today. Here's probably the biggest question we've gotten over the past few weeks: rising interest rates, and what does that look like moving forward? So we think interest rates are likely to rise, but only modestly from here. So what we did, we went back and looked at history, and interest rates typically have the biggest spike right before and at the beginning of when the Federal Reserve increases interest rates. So that's what you've seen so far this year. Interest rates have moved higher, and just last week the Federal Reserve increased interest rates for the first time. So if history never rhymes, but it also often comes close and repeats itself. we think a lot of that rising interest rate pressure has already happened. So to be determined on where we go from here, but we think we've seen a big piece of that already in the rearview mirror. What forces do we have keeping the 10-year U.S. government bond, which is the barometer for U.S. interest rates, below 2.5%? You'll see a lot of these pension bond allocations rising, just with the price of some of the bonds falling, and you're continuing to see a real elevated demand for foreign countries or investors purchasing U.S. bonds. I like to say America is still the cleanest shirt in the dirty laundry as it pertains to interest rates, where people can still invest in U.S. bonds and get a much higher interest rate on a relative basis when compared to quite a few countries across the globe. So on a relative basis, rates look quote-unquote high here in the U.S., which should be some buying. The devil's advocate to this would be, well, the Federal Reserve is going to stop buying. They're going to start letting some of the bonds that they've purchased since the spring of 2020 roll off or mature. That is a true statement. So you got, once again, kind of two factors competing against each other, and it will be interesting to see what happens from here, but we do not think interest rates get out of control. So what do we do in this type of environment? You know, we had a client who, a former client, she passed a number of years ago, but I told her a few years back, I called her by name and said, interest rates could move higher. And she laughed, and she was as sweet as she could be. She said, sweetheart, I've been retired longer than you've been alive. Interest rates are not moving higher. And she wasn't wrong. From a standpoint, she had been retired for 40 plus years. But even Randy, who's been in this business since 81, 82, we haven't lived through a time period where interest rates move higher for a prolonged period of time. Yes, we've had short bursts of higher interest rates. 2015, we saw that for a few months. 2018, you saw that for a few months. And there have been other examples here recently, but interest rates have historically worked in longer-term cycles. We haven't been in a long-term cycle where interest rates do go up. We're of the opinion that interest rates are going to grind higher, so you're not going to see just a huge spike in interest rates like you saw in the late 70s, in 80, 81. So it begs the question, how do we deal with this? How do we invest in non-stock investments without taking substantial interest rate risk? And it's a hard question to answer. Here's how we've answered it thus far. For our taxable fixed income, we focused on income-producing assets that are less interest rate sensitive. That means if and when interest rates rise, some of these investments are going to be less sensitive to that. Preferred stocks are a big piece of that. Floating rate bonds, which are currently our largest position in our taxable fixed income portfolio. Floating rate bonds can increase their income as interest rates move higher. Real estate, lower credit quality bonds, so this would be owning a triple B bond opposed to a single A, double A, triple A bond. Historically, the lower credit has done better in a rising interest rate environment. And then also some fixed income alternatives, which are for only certain investors, but this is something we're trying to turn over a lot of different rocks to see how can we best produce income without taking quote-unquote normal interest rate risk. So, got a question here. What kind or types of real estate investment? Good question. And when you look back at history, the residential real estate market has typically lagged when compared to commercial properties, when compared to rental properties, when compared to other types of real estate. But as a whole, real estate has done well in inflationary periods. So I think it's less about what kind and more about owning real estate in general. The old saying, "God's not making land anymore." That's very true. You're seeing a real cannibalization of some country property, specifically around the hill country, just with all this new jobs, these big companies relocating headquarters away from California for tax reasons, et cetera. So a lot of different options there. And I'd say real estate is a little more peculiar on a deal-by-deal basis. So hard to answer that holistically, but the two things that have held up really well in an inflationary environment, number one, real estate, but stocks have also been a great hedge against inflation when we look back and study the numbers. So thinking long term, humans, we are all linear thinkers. What that means, if it's been raining for the past 2 weeks, we think it's going to rain forever. And it's hard for us to really take a step back and think long term. Randy's guilty of that. I'm guilty of that. We all are. But this is a chart of the overall stock market from 1900 until the end of last year. And what you can see here, bull markets tend to last for a long period of time. Most recently, the current bull market we're in, we're 12 to 13 years into it. Bull markets in the past have lasted anywhere from 17 to 24 years. So we are not of the opinion that stocks go straight up from here. We are of the opinion that we continue to be in a secular meaning long-term, bull market, and have a number of years left with that. So will there be pullbacks along the way? Absolutely. If we look at the numbers, we average a 10% pullback once a year. We've already had that this year. You average a 20% pullback every 2 to 3 years. So that keeps the speculation out of the market, keeps the investors in. But we'd say that is over a long period of time, when it never feels like it in the moment, it is healthy to keep speculation down. So can stocks recover after a poor start? Obviously, stocks have had a poor start for the year. At the S&P specifically, I think was down 12 to 13% at its worst. You can see here, this is once again kind of a busy chart, but the red dots were the drawdown in that year, and then the actual grayish bars are what the year ended at from a total return perspective. So you can see there are some drawdowns in the year, but a majority of the time, the annual returns were positive, 32 out of the last 42 years. So markets had a little bit of a comeback here over the past week or so, and hopefully that does continue. But there'll always be a reason not to invest, and this is not even a holistic list. This is just a piece of what has happened looking back since March of 2009. But it's always something. There's always something to worry about. There's always something to fret about. And it's always going to be that way. Volatility is the price we pay to be a stock investor. That's always going to be true. So, like we said earlier, we don't think the geopolitical issues warrant any type of real significant change of course at this point. And we think the market continues to climb the proverbial wall of worry as it pertains to the issues at hand. So, a good question that kind of brings us back to the basics. And sometimes I think that's a real healthy exercise for all of us. What moves stock prices higher or lower? At the most fundamental level, stocks are going to move higher if the companies can continue to make more money and earn more money for shareholders. And to do that, you need a healthy consumer who is ready to spend money. Now, obviously, this is oversimplified, and there can be pandemics, there can be wars, interest rates, go down the list of different things that can really throw this off course, but at its core, this is what makes stock prices move higher. So our encouragement is let's block out all the other noise. CNBC is not your friend. Most news media outlets are not your friend. The fact that they are trying to get the eyeballs glued to the screen, whether that's the TV or your computer or your tablet, and have you click more often so that they can sell that revenue, that advertising content at a higher revenue stream for them. So blocking out that noise is recommended, and we think a viable way to kind of focus on the things that are important. We did a webinar earlier this year talking about what we thought about for the year, and we had these bullet points on a slide. Randy and I both, we thought it was worthy of adding them back here because honestly our thoughts haven't changed a whole lot over the past few months on any one of these pieces. We think inflation starts to dissipate toward the second half of the year. American companies, we think earnings continue to increase. You're already starting to hear less talk of COVID, which is we're very thankful for. Looks like the Biden's tax plan is not going to happen as of today, and what we looked at earlier, the recession indicators, 10 out of the 12 of them still look positive, and you know, the wild card continues to be geopolitical tensions around the world. So, have another question here. It says personal debt is lower. Yes, government debt is skyrocketing. Is personal debt lower due to discipline, or is it based off stimulus and some debt forgiveness measures that have driven up government debt? Very good question. I would say both and. From a standpoint, you have seen people living below their means when compared to history. So I would say the biggest component of that would be people rolling up their sleeves, saving more, spending less. Part of that was 2020. There really wasn't much to spend money on outside of ordering food in or adding a Netflix subscription or something of that nature. And then you have seen government debt obviously moving higher. The biggest piece of the government debt has been, if you look at the balance sheet specifically, has been the purchase of bonds. And so those will, like we said earlier, kind of slowly roll off the book. So hopefully that federal total debt number slowly starts to move lower, the balance sheet that is, just as some of these bonds do mature and roll off the books. But I thought it was interesting. Not a lot from a fundamental perspective has changed since the beginning of the year from our perspective. Thought it was worth, we have a majority of people on the call are clients, a few people who are not clients. For the clients, thought it was worthy to spend just a few minutes reviewing our Live Well plan. And for those of you that are not clients, we're happy to put together a Live Well plan for you on a complimentary basis. But we think some of the best advice, whether you're in retirement or approaching retirement, is to have a plan. We don't think it's a plan unless it's written down. And this is something we're monitoring and looking at, whether it's with you, the client, or just behind the scenes on an annual basis. So love the quote from Benjamin Graham. Mr. Graham was one of the mentors of our friend Warren Buffett. He says, the best way to measure your investing success is not by whether you're beating the market, but whether you've put in place a financial plan and a behavioral discipline, very important, that are likely to get you where you want to go. So that is the foundation of everything we do. We're not just stock guys or bond guys. We want to pull together everything, and the stock component, the bond component, that is important, don't get me wrong, but we want to create and tailor a personalized plan for each family for their needs, wants, and desires. So a big part of that, as you can see on the screen here, your family index number. What rate of return does your family need to be, quote, successful? And success looks different for every family, but what we're trying to do here is we're trying to take the least amount of risk possible to get you where you want to go. So this really is one of the key pieces that we use when having clients block out some of that noise that they are hearing on a regular reoccurring basis from some of these news media outlets. We did a number of plan updates during the hearts of COVID, spring of 2020, where clients have said, oh my goodness, my stocks are down, my bonds are down, am I going to be okay? Is the question they're ultimately asking. And so we update the Live Well plan with levels at that time were distressed levels, values were down. And once the client would see, hey, my Live Well plan is not really thrown off course by this, you just see the client's face light up, or you hear it over the phone, and just kind of this sigh of relief. And what we're doing, as many of you are familiar, we're using Monte Carlo simulation, which is a big word for a country bumpkin like me, but we're showing clients going through retirement 1,000 times. We're taking that probability of success, factoring in the fact that we know there are going to be down periods with stocks, with bonds, with any type of investment, but we want that probability of success to be above 75%. 75 to 90% we think is really the sweet spot. So it really does. Randy loves using the 3 C's like an old Baptist preacher: comfort, confidence, and clarity. We think this Live Well plan really provides those during turbulent markets. Do you need an investment process? A little bit of a, to use a March Madness analogy here, we think it's a little bit of a layup. We think the answer is yes. But how much can you spend in retirement? How do you invest pre-retirement versus post-retirement? We're big believers in dividend-paying stocks. And we think companies that not only have increased dividends in the past, but hopefully can continue to do so in the future, those are the most financially viable companies to own over a long period of time. And it goes without saying, but investing without a process is kind of like going to Vegas and just putting money on red at a roulette table. If you invest without a process, the probability of you being quote-unquote successful goes a lot lower when you look at the statistics, when you look at history. What we're looking at here, this dark green line, is the S&P 500. This lighter green are when people purchase equity mutual funds from all the mutual fund companies, and then the grayish shade would be when people purchase bond funds. And so you can see here the highest equity inflows or the highest equity purchase of mutual funds happen at the peak of the market, where the same set of people, for the most part, are selling when the market bottomed spring of 2009. And we understand why. It doesn't feel good when you're here as an investor. But having behavioral discipline, having an investment process, knowing exactly what you own, these are critical factors to be successful, not only during good times, but during the bad and during what we think of as complete market cycles. And one more slide here, just talking about dividend income. This is 1930 through the end of 2020. Haven't seen the updated 2021 number as of yet. But when you look back at the total return, and total return are dividends plus any price appreciation or depreciation. You see here by each decade, and over on the right, the overall total of what the dividends contributed to the total return. And so 41% of the total return came from dividends. That is a material figure, and just another reason why we think owning dividend-paying stocks is critically important for anyone in retirement. So we've already had a few questions. Any other questions? You can type them in there in the chat box, or if you want to ask a question offline, shoot us an email, give us a call. We are We're here to help. Don't see any more coming in, but like I said, send us any that you do have. Want to say thank you from Randy, myself, the rest of the team. Let us know if you need anything, and hopefully this was, trains are running a few minutes behind schedule, but we're in and out in 45 minutes, and hopefully this was educational and got some questions answered. But if not, please let us know. We're here to help, and we appreciate your continued trust. Talk to y'all soon. Thanks.